everyone, I am CA Vibhuti Narang. Welcome to our channel Voxcov Academy. In today's video, we'll be having part 4 of income under the head profit and gains from business and profession, in which we'll be discussing in detail about the expenses which are disallowed under the above mentioned head. Before that, we have already covered 3 parts in which we discussed in detail about the expenses which are allowed under PGBP and in detail about the incomes which are to be taken under section 28. If I broadly discuss about the topics which I was covering till date under this head, we have done with meaning the expenses which are allowed. Now we are doing expenses disallowed, and part 5, 6, 7 will respectively be covering presumptive taxation, partnership and corporate taxation. Before starting with the relevant sections under this head, we need to understand when an expense is disallowed. Ideally, all the expenses are allowed, but there are some specific rules or conditions due to which they are being disallowed by the income tax department. They do not allow the benefit of such expenditure, and the assessee or the taxpayer are required to pay tax on such expenditure by adding it back to the net profits. Ideally, what happens is all the expenses we charge on the debit side of our profit and loss account, but there are some expenses which, due to certain conditions which we'll be learning in this video, are not allowed and they have to be added back to the profit. Why? Because when you were calculating the profit, you have deducted those expenses. If the income tax department do not want you to take the benefit of those expenses, you have to add back to your net profit and you have to pay tax on the increased amount of net profits. Right. Now talking about the first section, but before that we'll understand the brief example or why this case study is being developed. What happens is, let's suppose there's a company, Voxcov Private Limited. Now being a company, the company is a deductor in nature and the services are being provided by CA Vibhuti to this private limited company. In return, what this company will be doing? In return, the company will be paying the relevant deducting TDS. That is a small concept, right? This section is relevant for only those assessees who are required to deduct TDS but have failed to do so. Right? Now what happens is both the parties will prepare their profit and loss accounts. In the case of the deductor, the expense is a expense which is being charged on the debit side of profit and loss account, but in the case of deductee, it is an income. So she will be charging on the right side of her profit and loss account. If the TDS is deducted, both the things are normal. Normal in a sense, the expense is booked and the income is also booked. The deductor takes the benefit of the expense, the deduction, and the deductee takes the income. Let's suppose if the TDS is not deducted. Ideally, the TDS concept was being made applicable just to curb the effect of tax evasion, so that no one or no person evades tax and pays tax on everything. If the TDS is deducted, that is reflected in 26 AS of the deductee, and the deductee has to mandatorily file return and show or disclose that income in his or her income tax return. What happens is if the deductor fails, then in that case the deductee may try to not show the income of that relevant part. Now just to control this mechanism, they have made a disallowance on the part of the deductor, mandating that if you fail to deduct or you deduct but you do not deposit the TDS, you will not be allowed such expenditure in your profit and loss account. Right? So I hope the brief history is clear. Now the section is which says that there are two conditions or either of the one is relevant. The TDS is not deducted before the end of the previous year. For example, in my case, the financial year is 2021 and the tax has not been deducted before the end of the previous year. In that case, there will be some consequences and the expenditure will not be allowed. The second case is the tax is deducted in the relevant previous year, that is 2021, but not paid or deposited before the due date of filing of return of income. Now for these sections, you need to understand the due dates of return filing. For example, the company SSE is there. His due date is 31st October. Now in that case, what happens is If the tax is deducted but not paid till the due date of filing of return of income, in that case 30% expense is disallowed. In a sense, in my case 1 lakh was the expenditure, 30% is disallowed, that is 30,000 will be added in the deductor's net profit and tax will be charged on the higher amount. But if the deductor pays the tax or deducts the tax in the next subsequent financial year or the previous year, in that case in the next year the deduction is allowed. Right. So if the tax is deducted in the next financial year or paid after the due date but in the subsequent previous year or financial year, the deduction is allowed in the next year. Similar to this, there is a section which is 40A1, that is any sum payable other than salary to a non-resident or outside India. All the conditions are same, everything is same, except whenever such kind of consequence is there and the tax has not been deducted, then 100% sum is disallowed. So if there is a payment, any payment other than salary, means it can be interest, royalty, technical service, anything you are paying to a non-resident, but the consequences will be 100% sum will be disallowed in the hands of the deductor. Again, the similar section which is there is 40A3, which is salary payable outside India or to a non-resident. Now this is specifically for salary paid to a non-resident or outside India. What happens in this case is the on which the tax has to be deducted is neither deducted or before the end of the previous year not being paid. So there is no deduction of tax, neither the payment of tax before the due date of return filing of income. 100% sum is again disallowed, but there is a turning point, the subsequent deduction is not allowed. So even if there is a delay by 1 day also, for the deduction or for the payment, the sum will never be allowed in the subsequent financial years, right? Now we have another important section which is a payment made to relatives. What this section says is, suppose there is an assessee and there is a specified person. Now who is a specified person? He or she is a relative of the assessee. The assessee is giving any goods or providing any services or any facility is there which is being given to the specified person. The meaning of definition will be covering in the next slide. And in return, the assessee's relative is paying the amount of the expense to the assessee. In that case, the assessing officer may or shall disallow the excessive or unreasonable amount. For example, there is an goods which can be given in the market at 8,000 rupees, but to the relative it is being given at 12,000 rupees, right? So the 4,000 excessive amount over and above the fair market value will be disallowed, right? So any such expenditure which is more than the fair market value or which is not in the actual need of business, the expense was not required in the normal course of the business, but still the assessee has done such expenditure to the relative, then the unreasonable or excessive part will be disallowed by the assessing officer. Who are relatives? In the case of individual, it is the spouse, brother, sister, linear ascendant and linear descendant. In case of a firm, the partners and their relatives. In case of an HUF, the members and their relatives. In case of a company, directors and their relatives. And in any other case, any person who is having substantial interest, that is 20% or more voting or share capital power in the company or any organization. So if you have any substantial interest, then you are a relative. Other than this, the list is given. Next, which is very important, and this section is relevant almost in every other sections of the expenses allowed part we have done. So whenever an assessee is making payment of any expenditure, the payment or aggregate payment made, now there are three conditions. First is the aggregate payment or a single payment is made to a person in a particular day and the payment is done otherwise than an account pay check or draft or electronic clearing system, that is ECS, either your net banking or mobile banking. Other than this, there is a payment done of an amount greater than 10,000 rupees. Now to curb the cash market, this type of a section is into existence. What we mean to say is the payment should not be done to a person in a single day more than 10,000 in cash or through a cross check or through a bearer check. So the amount is restricted till 10,000. You can do the payment in cash. Other than that or over and above that, you have to make it through the normal account paying check or a draft or electronic clearing system. Now, this limit is enhanced to 35,000 in case of good transport agents. So, good transport companies or transport operators, they can in a day transact up to value of rupees 35,000. Before understanding some other details, one thing, there were many sections in part 2 and 3 which I covered, like there were purchase of an asset, the actual cost value, or any other scientific research sections were there. Wherever there was an amount to be paid in cash, the amount cannot exceed rupees 10,000. So this is relevant for all other sections we have done so far. For example, we'll have certain example. Person A is making payment to person B. Now this payment is of 8,000 in cash. So will it be allowed or not? Because it is below 10,000 in cash, it is allowed. For example, in example number 2, the payment is done of rupees 80,000 by a cross check. So this is neither a check nor a demand draft nor a ECS clearing system. So this will be disallowed. Third example, person A is making payment to person B 10,000 on 20th July and 10,000 on 20th July to person C. So there are not single person in a day. In a day there are two payments, but two different persons are being involved. So this expense is allowed. In next example, person A is making 10,000 payment on 20th July to person B and on 21st July, the next day, to person B. Then also this expense is allowed. But let's suppose on 20th July 10 am, the amount paid to person B is 5,000 and on 5 pm of 11 am, then 5 pm, the amount paid is 6,000. The total is 11,000 but below 10,000 both amounts are. Then in a day it is exceeding rupees 10,000 and it will be disallowed, right? Now there are certain exceptions to this rule. Now the rule 6DD, which covers the section, says that no part of the payment shall be disallowed if it is exceeding rupees 10,000 in the following cases. The cases are, even if you're making payment to any government, bank or financial institution, for example for any taxes, it can be either GST, the income tax or municipal taxes, whatever the case is. Because you're paying directly to the government, you can pay it in cash, so there is no upper cap limit on this transaction. You are required to make a payment on which there is a government holiday or the banks are closed, like 26th January, 15th August, 2nd October, any other day on which the bank is not working. At a place where there is no date of payment of banking facilities not available. So like any rural area is there or any village is there where the banking facility is not available, then in that case the payment in cash is allowed. The next case is any terminal benefits like retirement benefits or gratuity, but the upper cap limit for cash transaction is 50,000, so it should not exceed rupees 50,000. Then to any employee on a temporary basis, if he or she is posted in any area where he do not have any bank account. For example, employee situated in Pune has gone for a project work for 1 or 2 months, that is more than 15 days, and in that project area, in a rural area, he do not have the bank account over there. So he will not be able to realize money through the cash. Then in that case, even if you're paying to your employee in cash, that will be allowed. Beyond that, if there are any purchases done of these following goods like agriculture, forest, fish, poultry, dairy, animal or products without the aid of power, then also more than 10,000 rupees is allowed. Right, so these were some exceptions to the section 48.3. Now one important section we'll be discussing, which is 43B, many times discussed in part 3 and initially in part 4 also. This section says that if you are paying any sum by way of any tax, duty, cess, fees to the government, or you are paying any bonus commission to the employees, or any interest on loan or borrowings or advance from any public financial institution or state financial corporation or state industrial investment corporation or a scheduled or a cooperative bank. So from any of these, any transaction is done or a leave salary is given, this is not on due basis, this is on actual payment basis. So accrual concept is not applicable over here. Any sum payable through any of these 4-5 means, in that case actual payment of the expense is very much mandatory, and this payment is to be done till the date of return filing of income. So date you are filing your return of income, then it will be allowed in the particular financial year. If you are making the payment beyond the filing of return of income, it will be allowed in your next financial year. So for example, the financial year 2021 is going on. The financial year is from 1st April to 31st March. The expenses pertaining, but if this paid to the till the ITR, that is your return filing date, then it will be allowed in 2021. Otherwise, it will be allowed in 21-22. Now the next topic which we will understand is some tax payments allowability concept. That is, we have some direct and indirect taxes, and the direct taxes are up to some extent disallowed because this is the tax which is paid on your income, and income is personal in nature because all the other expenses are being given in the profit and loss account. So the act says that if any tax of direct nature like income tax, wealth tax is there, then it will not be allowed as deduction. But if it is an indirect tax like GST, it will be allowed as deduction. If the tax is not allowed, then if you are having any loan for such tax repayment and interest is paid, then in fact that will also not be allowed. But in case of indirect tax, it will be allowed. If there is any interest on late tax, so again, if the normal tax is not allowed, so late payment interest again is not allowed, but indirect tax it's allowed. Refund of income, when expense is not allowed, income cannot be recognized. So in that case, it is not an income, but in indirect case, it is an income. Penalty fine in both the cases is not allowed. Legal or return filing fees is being paid, then that is allowed as deduction in both the cases. And any interest on refund is received, then it will be charged under the head other sources. So these were the all important sections, which there are many other sections. I already told you the PGBP topic is very vast, and there are very a lot of sections are there which are covered under these topics, but only the relevant parts I have covered. This is not considering any examination point of view. So this topic, for reference purpose, the PDF of this PPT will be available on my website voxcov.com. This is under basic income tax part. And you can follow Voxcov Academy on Facebook, Instagram, Twitter, LinkedIn, and subscribe to my YouTube channel for future updates and notification. Thank you very much.